Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone exciting, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week. And a look forward to what might happen in coming weeks. And hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market chopped in a relatively tight range this last week with focus on President-elect Biden's rescue package, which was revealed to us on Thursday. It was no secret because there was a lot of advance news on that, as they wanted to make sure that the leaks came out and people could get ahead of what was going to be coming. Monday, stocks fell a bit after the previous Friday's late surge, and Goldman Sachs said that you should buy stocks even though they're more overvalued than we had in the dot-com period. It was also a big day for Bitcoin as it moved to the downside very seriously overnight. It had been as high as 42,000. It approached 30,000 overnight, but then moved a lot during the week. Thursday, it rebounded 10%. Friday fell about 7%. Actually, now Friday, here we are around midday, it's down around 9%. So incredible movement in there. Bitcoin now trading around 36,000, and we believe that very soon, maybe in the next couple of weeks, it will trade down to about 28,000. Tuesday, we saw pressure on stocks as big tech moved sharply to the downside in an uproar over what was going on in social media, as that and some other big techs like Amazon acted to silence conservative voices as they saw that there was risk based on what happened at the riot at the Capitol. I'm restraining myself with comments. Those of you that know my political stance, I'm going to put an end to that right there. They were actually pushing Pence on the 25th Amendment also on Tuesday, as the Democrats threatened, if you don't do that, we're going to file articles of impeachment, which they finally did. That's the second time that President Trump has been impeached, and that's the first time in history that's ever happened to a president. But the big decline that we saw in the market then on Tuesday reversed as there was a surge in bank stocks, which were very strong all week long, benefiting from a steepening yield curve. Wednesday, stocks were up. It was more of that big rotation. This time, not only the banks, but energy stocks moving up very sharply. And there even seemed to be some panic buying in some of those energy stocks, as of course, we are at a period now at all-time highs in the stock market that investors are looking for some value because it's getting harder and harder to find that at these levels. Thursday, Powell had an online symposium from Princeton, and he said, well, it's not the time to talk about rates going up anytime soon or to talk about exiting the QE program. Well, the bond market is starting to get ahead of them, and that's what we expected it would do as interest rates have been moving up, and we believe, and we've declared this if you watch our year-end show, that a bond market bear market is here. President-elect Biden, he rolled out Thursday his $1.9 trillion relief program, and markets were weak, and there was selling ahead of that. It's going to be tough to pass. First of all, he needs 60 votes in the Senate to get that passed. Goldman Sachs came out today and said that the best they could see is $1.1 trillion relief program getting passed. The problems are that there's a lot of pushback. First of all, giving big money to state and local governments who do not know how to run themselves, and the potential for that money ending up in pension funds and pay some debts versus getting to the people that need it, and also an absurd 15% national minimum wage, which it's a terrible time to be doing something like that because Well, small businesses are struggling in such a big way, and there's so many people unemployed. And if you make it much more expensive for these people to get employment, then the small businesses are going to be hurt more, or they're not going to hire people. So this is some of the worst timing I've ever heard for a $15 minimum wage. Really terrible to be in that program. So again, you got to worry about, well, how's this all going to be paid for? It's just going to mean more big borrowing. That's going to put upward pressure on interest rates. And of course, as we know is coming with a Democratic-run Congress and a Democratic president, big tax increases are down the road, not too far. So stocks were weak Thursday, as investors did get ahead of that news and thinking now that maybe the good news is behind them. Friday, stocks were under a lot of pressure. They sold down very hard early in the day. EU countries, they have more lockdowns based on COVID-19. The UK came out and said they're having negative growth, which means that there's a potential for a double-dip recession for the UK. And then Pfizer kind of really accelerated the selling when they said that there would be a delay for vaccines coming to the EU, some delays there. So traders got nervous about that. They sold the stock market down very hard. At one point, we see the Dow down 400. Russell was down 50 at one point, 2.3%. And then there was a big bounce that came into the markets. They cut back more than half their losses, but not in the Russell. The Russell is still down pretty significantly, 1.6%, as we do this show now at midday. So a lot of selling coming in here on this Sell the News, and investors digest some of this plan and that pushback that is likely coming on that plan. So with the stock market acting pretty much as we have expected, our analysis remains the same. Upside now we see as very, very limited, with a risky period coming between end of January into early March. I get tons of pushback on that on social media, with people writing to me that say there is no way that the market's going down. The Fed has complete control of it. They're planning to print all this massive amount of money that is going to happen with the Democrats in control. So how can the stocks possibly fall? Why do you think they rallied? Why do you think they're at these levels? Everybody knows that there's a massive amount of stimulus coming and printing coming. It's in the market. And now we have to deal with markets looking at alternatives, like a bond market that is giving higher yields and is likely to give much higher yields sometime later this year, and valuations that are off the charts. We've talked about so much of that, and evaluations are very much off the charts, but there's other things to be talking about here regarding reasons why the stock market may have a rough time of it. Let's take a look at this slide right over here. This is Citigroup's panic euphoria sentiment indicator, this model that they have. This was recently put out by Zero Hedge. I grabbed it off of there, and you could see the sources on the bottom, but it's really out of Citigroup and their equity strategy area. And what they say here, and Tobias Lefkovich made a comment on this, and he says that right now there is, based on this, a 100% probability of negative returns in the next 12 months. Well, that sounds like a pretty extreme comment. Totally agree with him. What you have here is, you could see right here the .com period right there. That's 2000, and that was the last extreme euphoric sentiment that we saw right over there. And this down over here points to the likely 12-month returns, or the real 12-month returns that happened in there, as you could see, as investors got all in the market, that the returns were just terrible. Well, here we are right now at just absolutely record levels. And this is well above the sentiment that we saw over here. We don't know how much more crazy it's going to get. Oh, what is that? Okay, got rid of that. How much more crazy that's going to get. But then what is very likely to happen again is a period out here of pretty tough time to get any kind of returns in the market based on this. Why? Again, if all this euphoria is there, if all of these people believe so much that the market's going up, if all of these fund managers are reacting to that and have less than 4% cash available to them, then they are all in. And who's left to buy? I guess you could say they're going to print tons of money, and that money is going to find their way into the market. It's got to find their way into the bottom line, into these stocks and the earnings growth, which is really going to be awful. When you look at this, the sentiment is just really off the charts. Watch our New Year's show if you haven't seen that yet, and you'll see our analysis for the 5 major markets for the next 12 months, and we talk about that in there. You'll see we totally agree. Not only is 2021 likely to be a down year, but it's likely to have a bear market in it. So we wanted to share that with you, and you could see that it is a very, very euphoric state that we are in this market right now. So what I want you to make sure is that you subscribe to the YouTube channel if you're watching this on there. Go to askSlim.com and become a free member. Explore our site. On YouTube, click that notification bell and like this video. Make sure you give it a thumbs up. And make sure that you follow us on Twitter at askSlim. For membership info and our other specials and trials, please write to Matt at askSlim.com. So the next thing we're going to talk about, let's just wrap up this week, is that the stocks for the week right now, they're down they're mixed. Down the major indexes 1.5% to 2%, but the Russell's still holding about a 1% gain as those low caps have been really strong. Friday's kind of a downward reversal day for them, though. Bond market 30-year gains about 0.5 point in a slight rebound. 10-year yields fall only about 2 basis points. Again, on a bit of reversal here on Friday. Gold down about $18. Silver down 70 cents, and that mostly came here on Friday also as we get a move upward in the dollar again. The dollar up 0.6% on the week, responding to strong interest rates, and the oil market down about 27 cents on the week. And this looks like a reversal Friday and there. We've been looking for a peak potentially in the oil market here for the short and intermediate term, and I think we are getting that right now. So oil market looking like it's peaked. All right, so let's talk about some of these markets in here. We're going to show you the silver market, but before I do that, lots of demand that we've had and requests to do analysis on India. RV did a fantastic job on a video we just posted on YouTube. If you're watching this and have interest in India and India stocks, he did great analysis on the on 4 of the key stocks that come out of India and the Nifty 50. So great analysis by R.V. Ramachandran, our expert cycle analysis analyst, and please do go and watch that also. So now we're going to move over into look at the precious metals and the stock market. The precious metals, they should be doing well in an inflationary scenario. All of this talk about all of this printing that's going to be going on, well, that should be killing the dollar, and it should also be helping and the interest rates also, while they're going up, should help the precious metals markets, because everybody, of course, gets nervous. Inflation in there, interest rates respond, they move up. Precious metals, they respond, and they move up, and all of that seems to be correlating in a little different way right now. So if the government stimulus means inflation, it should move up. Instead, it's moving inverse as the dollar moves up and yields move up. It's an important time now for silver and gold, and I'm going to show you that. I actually think that silver and gold are more interested in, or investors are more interested in the deleveraging risk that we see in here right now. We see it, and I think that investors are seeing it. So we're going to look at the 1 to 3 month outlook here in the silver market and the gold market, and then of course in the stock market also. So let's switch over now and look at this weekly chart of silver. So for those of you that are new to our work, this is cycle analysis. And on the bottom, you see those cycle brackets. Those are those half moons. They are a drawing tool, and they help us to understand the rhythmic motion in the market. So this great big cycle right in here, that we call that the dominant. This is the intermediate right here, and there is a minor. We're looking at the black ones in here, and the gold ones, well, those are gold. So we have silver overlaid with the gold cycle, and they were all nesting right in here. There was a period of nesting right in here, and that brought a big rally. The same thing right over here. So when the cycles come down is when there's downside risk. When they move up is when there's upside potential. So let's talk about where we are right now in the silver market as I blow this up a little bit. So we have a market that rallied up here. It got close to that 78.6% right over at that level, and then reversed, and then gave you this engulfing pattern, actually. Now it's come down into support, and the short term has broken some supports. But you can see the intermediate term here on the weekly chart is moving into this kind of lower support zone right over here. There is an expectation now that the short-term breakdown is going to bring declines through the end of the month. That would mean another something like 2 to 3 weeks of potential downside. If it holds in this support zone right over here, it could be in good shape and then be moving up again. I have this highlighted in yellow right over here so that you can see that there is a similar occurrence right over here. After these cycles made their bottoms in here and then moved up, this had a rally and then a pullback. Now, it wasn't as steep as we're seeing right in here. This is not a violation on the intermediate pattern. It is the potential for this being a shakeout in the intermediate pattern. And once that short-term pattern bottoms in the next 2 to 3 weeks, it's possible that the silver market will be moving up sharply again after that, just as it did right over here. You could see that 4-week rally of some significance where silver went from $15 up to $18.50, a very significant percentage increase, and that could come right out over here. So we're looking at a 1 to 3 month view, and our 1 month view really is that it comes down in bottoms and then begins to move up for a couple of months after that, as long as these things hold above key levels. So we don't want to see silver get below here, which is around 23.10. That's still a long way down. This bottom of this support level here, which it got close to, is at around 24.25. So it's 24.80 right now. It's still not in any danger, and our sense is that it will hold in here, and then we're going to get a good long side trade up in here. But if gold breaks down, it's going to be a very significant problem. We'll call silver still okay, and potentially putting up a very good opportunity to be a long side trade in the silver market. 1 to 3 month view for silver. So now let's take a look at our 1 to 3 month view for gold. Gold is in a little weaker condition. I'll switch over from SI to GC as I look at the gold futures markets. Again, what I want to do is I want to review this a little bit because we have so many new viewers out there. And again, if you want to learn cycle analysis, I'm going to show you about a special that we have coming up in just a moment. So what I'm showing you are these big cycle rhythms right in here. This is the harmonic family of cycles right there from key low to key low. If you want to understand the very basics of this, please look for a new video we're putting out on the cycle analysis basics that we have given to our members right now, so they get a little jump on that, and we'll be letting our free members see that also this weekend. So look at this perfect cyclical pattern that we have in here. Now I want to focus on this, the intermediate cycle right in here that went from this distance to here. You can see how the cycle shaped right in there. It gained 13% off of its low. The next one gained 24%, the next one gained 23%, and the next one gained 24%. Look at that, beautiful. Last three, 24, 23, and 24. So if this one right over here gave you a 24% impulse to the upside, it would take you to the top of this fib extension zone right up around that area of $2,175 up to there if it continued in this same pattern that we're in right now. I'll take a little closer look here. What has happened is that 1863 support low on the shorter term pattern broke down, just as it broke down similarly in the silver market. Now, the gold market is getting closer to that key 1806 78.6% level, where silver market is not doing that. Silver market is holding above this 61.8%. So in here you could see silver is actually stronger than the gold market. If it were to get under this level at 1806, that would be a warning, a very, very significant warning. And if it got under this level here, which it's still quite a ways from, at around that 1767 level, the bull would be dead. So we're not calling for that right now. We'd like to see it hold above that 1806 level. And again, it's got to get through some short-term weakness in here over these next couple of weeks and then do a little bit better. It's this week, gave a little bit of ground. Silver was actually weaker than gold this week. And this overall pattern here is threatening. If you look at this minor cycle right in here, you can see that that points way out here into the mid part of February. So while silver looks like there's a potential bottom around the first week of February, gold looks more like it's around the second week of February. All of this needs to hold in this area, and for this cycle to bottom so that it can then get its next significant move to the upside in there. And these are very, very key times. Now, I want to go back and look right over here. You could see this anomalous break right over here. And it just almost got to a breakdown level and then avoided the breakdown and then began to move up sharply again. This is when there was that big leveraging that went on in the times of the shutdowns in the economy when COVID-19 hit last spring. So this decline, the market survived. That would be similar to this time period over here where it needs to survive so that it could then move up again. If it is able to do that and get into this period over here, you could get some very significant upside after that to the gold market. Again, these important levels, 1806 and 1767. Below there is a warning, but not a real breakdown, and below this level at 1767 would be a breakdown, and then this major cycle right over here that's pushing up would declare it has no more upside pressure and begin to put downside pressure on the gold market. We have anticipated that there would be a significant rally out into mid-year and be able to make new highs. That was what we said in our year-end show. We still are holding to that based on these patterns. It is still possible and maybe even probable, but we need to watch these real key levels. 1 to 3 month view is that it's going to struggle in here for this period over this next month, hopefully hold, and then into the following couple of months, the potential for some big upside if it is able to hold those key levels. So that is a look at the gold market. So I've been telling you a lot about our cycle analysis, and I just made a point that we put out a video for our members, and if you want to watch that, you could see it as a free member. If you want to subscribe to askSlim.com if you're not, on cycle analysis basics. I think you're going to find that to be absolutely fantastic as we put a lot of clarity into helping you understand how we approach building our charts for our style of analysis. So this is important. If you become a free member, you're going to be able to watch that. But what is the next step? Well, the next step in learning it is to become and invest in our cycle analysis workshop. It's back in the time when the COVID crisis hit, so that's all, it's just about 10 months ago is the last time we ran this special. We don't do it very often, pretty much close to once a year. This is the time to take advantage of this. We wanted to do it now because of all the questions about cycle analysis and the basic video that we put out, this is the time to do it. Learn about Slim's method of analysis developed over the last 45 years. It took me 2 years to write this and over 6 months to produce 20 video modules. Plus, we also link you to many of the tools for text videos that will help you learn this analysis. So not only is it 20 video modules, but if you're a level 2, 3, or 4 member, you're going to have access to all of the tools for text. And that will give you over 80 videos in there. But in here, we give you the links to those specific videos that are associated with learning cycle analysis. After you do this, you will never look at charts the same way as you did before. Never. I promise you that. As we teach you how to do analysis in a very different way and project not only in price but in time. So go to askSlim.com, go to the Workshops tab at the top on the nav bar for information. Also, if you write to Matt at askSlim.com, when he sends you information, he's going to send you our new demo reel, which has clips from most of the videos there, just little clips that you'll be able to get a good handle for what is in this 20 video module workshop. 30% discount right now. This is the biggest discount we ever give. And I want you to write to Matt, M-A-T-T, at askSlim.com for this special link. We'll give you that 30% discount, and they'll send you some more information on that, including that demo reel. This is the way to really get to really step up the style of analysis that you do, and to learn to approach analysis the way that we do. We teach you how to not only do cycle analysis, but to apply many other studies to the cycle analysis as we do also, and learn all about how chart formations occur and how the money flow conditions are what makes all of these cycle patterns so important, and how you can recognize them just basically at a glance. Fantastic information, 30% discount on our cycle analysis workshop. Write Matt at askSlim.com, and he will send you this information and that special link so you can invest. And believe me, it's well worth it. All right. So now we're going to get into the stock market analysis for the next 1 to 3 months. We are going to look at the spiders, SPY. And the SPY I've talked about in the beginning of the show, and I continue to talk about that. I think that there is a topping period right now, and that sometime by the end of January, we're going to be entering into a corrective process, which should take you into the late February through early March period in the stock market. Let's look at that and see where that comes from. I'll switch from this gold futures here to SPY, the spiders. And here you could see our big chart here of analysis. First of all, you can you can clearly see that there is a big megaphone in here, the great megaphone, and that there are cycles in here that are just remarkable, how that they keep repeating. The wave action in here is fantastic. The yellow ovals that you see in there are the periods where there are likely corrections. Where do they come from? Well, they come from periods of where after the cycle peaks and you get into these declining periods, as you could see right in here. Each of them are fairly significant. A very bullish condition might only yield a 6% decline. This was 6%, this was 6.7%. This was a remarkable only 4.2% drop right over there. But it is very common for these declines to be much bigger than that. This, of course, was the panic in last spring of a 35% decline. This one right over here was at 10.8%. And right now, we're looking for a correction of around 10% in the market. We think Russell might be a little bit larger than that. So what we're looking at here, as you could see, are these dominant cycles right there. and the minor cycle that you could see right in here. Now, this cycle peaked on week 18, this cycle 16, and fell through week 18. This one was on 19, it fell through week 24. This was a long one, 24 through 27. And right now, that is week 15 that the peak in. So we're in week 16 right over here, week 17 coming up next week. So there's a potential for a little bit more that it will hold up in here, and that's what we've really been talking about. So the expectation is that we are going to get this corrective period. Again, where these two cycles nest is where there is the greatest downside risk. Has happened right in here and happened right in here and coming into that period right in here. So we expect that we are in some kind of a topping process. The downside supports are at these key levels that you see right in here. So we're trading at 376 right now. The peak was made at 381.5, and 376.5 is where we are right now. And the downside projection is down to this major 23.6% level. That aligns with the intermediate 61.8% level at 343 on the spiders. That would have you have a decline of 10%. And for those of you that follow the SPX, the S&P 500, that would bring you down into the low 34s. And that other supports in here are significant also. So this is the 38% at 357. That would take you down about 200 more points in the S&P 500. This one right over here is at 350, and that's the 50%. So it's the 38.2, the 50, and the 61.8. Those are extremely likely occurrences, and I think that the normal level here would be a 10% loss at that major 23.6%, which is the same place as the 61.8. And all of this risky period in here is in the later weeks right there. So that's why I say this goes out through the beginning of March right over here. The next, in this 1 to 3 month analysis, what we're looking at is, potential little upside move again in here, and then some topping going on, and then the last few weeks in here, which is probably somewhere around the second week of February through early March, are the risks of the acceleration to the downside in here. So choppy in here, set a top, and then accelerate to the downside. I think if I'm going to be wrong about it, there's two ways that this analysis would be different. And that is, number one, it would fall much faster. In other words, it would start to move down now. Or number two, the market is so strong from this upside momentum that you see in here that it only allows it to correct maybe to the 38% right over here, 357 on the downside. And that would set up likely the test in May, June to be actually at a higher level. So get up here and then out over in this area here, I think the major bull market top. If this fell down below to this 10% level, or even lower to this 38.2, which would be a 16% drop, then the odds would be greater that this next rally phase out over here the following couple of months would not get as high as that level, maybe get somewhere around half to 3/4 back, and then some kind of a big decline out over here. So I'm getting out more than the 1 to 3 months, but I wanted you to get a picture at how I'm using these cyclical harmonic families to be able to, number one, project timing, number two, using these support levels to project where I think it would come down to. I really expand on this in the cycle analysis basics video that will be available to our free members this weekend. So if you're not a free member, please, and you're not a member at askSlim, sign up for a free membership, and you'll be able to watch that just excellent video, which is really the very, very first step to understanding this way to look at markets, cycle analysis. So 1 to 3 month view, a pretty significant risky period coming down into the March time frame, and then May, June being a better period for the market, a rebounding period, and a potential new high period for the stock market if we have all of this timing align up in the ideal. This would be the ideal. There could be some fluctuation with an earlier bottom or even a later bottom, because you will learn in the workshop, Cycle Analysis Workshop, about Hurst's 8 principles, and one of them is the principle of variation, which basically says these lows come plus or minus some bars. There's always shifting around in here, and this is purely an art form. You see this low right over here? Well, that came about 2 or 3 weeks late. As you can see that right over here, these are simply the average lengths of cycles, and the average length of cycle here says that it's going to decline into this March period, plus or minus a little bit of time. That is it for our look at the spider, SPY, and a look at the stock market. I want you to be so unbelievably careful, because it is so crazy out there. And the first way to be careful about the markets is to make sure that you do go to askSlim.com and explore it. If you're watching this on YouTube, subscribe to that channel, give it a thumbs up, and watch for all the videos we put out there, and member videos that you can see in the playlists. Follow us on Twitter at askSlim, and write to Matt for information on our trial memberships or on this special that we have on our cycle analysis workshop. That is it for this show. As I always say, I want you to be so careful out there. It is so crazy, and we're always wishing you great trading.